SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi e-lecture on money of the future. What will money of the future look like? From the rapid rise of stablecoins to ongoing work on central bank digital currencies or CBDCs, e-euro for instance, the foundations of money are evolving quickly, raising fundamental questions for financial systems, for banks, and for policymakers. This high-level webinar will address key policy and analytical questions, including the implications of new forms of money for financial stability and monetary policy, the interaction between stablecoins and CBDCs, the role of central banks in changing monetary landscapes, the impact on banks and financial intermediation, and global perspectives across major jurisdictions. Before we enter into the core of today's discussion, let me thank SUERF fellow Martin Scheicher, advisor at DG Horizontal Line Supervision at the SSM/ECB, for organizing this webinar, for taking the initiative, and for preparing everything. And let me also give a warm welcome to Natacha Valla, Dean of the School of Management and Innovation at Sciences Po, and a long-standing member of SUERF's Council of Management, who will then introduce our panelists and moderate the discussion. Without further ado, over to you, Martin.
Good afternoon and welcome to this webinar also from my side. So in the next few minutes, I'm trying to give a broad overview of our topic today. The starting point, and I think quite an appropriate one, is a quote by John Maynard Keynes: "The importance of money flows from it being a link between the present and the future." So money is really the core instrument of a market-based economy. It has two specific functions: as a medium of exchange and payment, and as a store of value. It has a long and, one could say, rich history, from Babylonian clay tables via banknotes to nowadays digital assets. The common concept today is fiat money, so not really convertible to gold, but simply a way of representing value. The two main types of money used today are cash. So this is the banknotes, which most of us still have in our pockets, issued by the central bank, and the bank deposits, private money issued by commercial banks. So if we could go to the next slide to talk a little bit about what is actually digital money. So digital assets are traded, used, and stored digitally. They use a secure technology to make payments and record ownership on a centralized system. This is this distributed ledger approach, and here the most famous one is blockchain. Today we are going to focus on two key types of digital money: central bank digital currency. So this is from the paper banknote in our pocket to a digital banknote issued by the central bank. And the second is the stablecoin. This is a crypto asset issued by a typically private non-bank with the value at the moment almost overwhelmingly pegged to the US dollar. Two comments on this. First of all, Bitcoin is not a stable coin, but it's rather a highly speculative instrument without any fundamental cash flows, so something like an electronic tulip. And then we also have the tokenized deposit. This is sort of a hybrid product. It's a commonly used deposit at the commercial bank, but it is recorded on a blockchain, so sort of bringing the bank deposit to the crypto age. On the next slide, a brief summary of the main features of the two instruments which we are going to discuss today: stablecoin and CBDC. Stablecoin, the issuer is at the moment mostly non-bank, although some banks have also entered this game, but overwhelmingly it's a non-bank. CBDC is publicly issued by the central bank. The use cases for stablecoin are, and of course this is a quickly developing market, so I'm speaking about the situation at the moment, are mostly crypto trading and cross-border payment. For the CBDC, the idea is to use it to settle retail payments. Regulation in the US, it's the Genius Act. In the EU, the somewhat more modestly named MiCA framework. And then for the Euro area for the CBDC, the regulatory framework is still pending and is currently still in the EU Parliament. The current situation is overwhelmingly data dominates the stablecoin market with more than 60%. It's domiciled in El Salvador, and according to some analyst reports, around 25% of its assets are not necessarily high quality liquid assets. CBDC, many countries have started this. For instance, the Euro area, as we mentioned, UK, Sweden and China, whereas in the US, this has been put on hold. Key policy questions are how, on the topic of stablecoin, how is this going to affect banks? Is it going to lead to disintermediation? What is really the wider use case? In addition to crypto trading and cross-border payments, or will stablecoins really take off? Then related to the financial stability perspective, run risks, and the interconnectedness with what one could call traditional finance, so old-fashioned banking system. For CBDC, three policy issues are defining the holding limit. So in the Euro area, there is currently a discussion about setting it to a value of 3,000. The design, is it online or also offline? And of course, also here, the usage. So on my last slide, I'm trying to outline a few of the topics for today. So first of all, of course, the broader implications of the evolution of money for the financial system and central banks. And here I understand that Stefan has some views and thoughts of this based on his long distinguished career. Then when we look at the two instruments specifically, stablecoin versus CBDC, so can only one really dominate the market? Can they sort of live in parallel? Or actually, as a third bullet point, there is also a scenario that tokenized deposits might actually be the winners. So would banks in this market actually really have the last laugh? Then remuneration is a key topic. So the Genius Act prohibits direct remuneration, but there are some workarounds, and here Ulrich has done quite extensive work, so we are very interested to hear his views on this. Then, as with any other new entity in the financial system, there is always the question of central bank access, so this also applies to stablecoins. Will stablecoins get central bank access? Do all central banks actually need to issue CBDCs? From the other perspective, what is the impact of stablecoins and CBDCs on banks? So will banks survive, or will this sort of be another step at taking away banks' really lunch? Then a more geopolitical dimension, the US versus the EU versus China. So here we see very different approaches. So what is the likely evolution in these three areas? And then the last 2 points, implications for safe assets. So here, of course, given his very long work on this topic in the US, a very high impact, we are very interested to hear from Darrell any views on this. And then last but certainly not least, the broader macro financial angle. And as Markus has since the pandemic been working on the concept of resilience, we are very interested to hear also how this concept might apply to the topic of digital money. And with this, I would hand over to Natacha to start the panel.
Thank you very much, Martin, for this very useful introduction that gives us the overview of the topics that we will cover. It's an honor to chair such a distinguished panel, because every single speaker brings a very strong value to the debate. So we will start today with Markus Brunnermeier. I feel a bit silly to introduce the speakers. They're all so well known, but Markus is a professor of economics at Princeton University. He's a SUERF fellow, and we're proud of it. He's recognized for his work on, macro finance, financial stability, liquidity, bubbles, and a very strong provider of useful tools for those who teach economics nowadays. Darrell Duffie, how should I still need to present you? Professor of Finance at Stanford University, one of the world's leading scholars on financial market infrastructure, repo market settlement, everything that is very core to what we will discuss today. Ulrich Bindseil is a former colleague of mine at the ECB with a long, high, distinguished career at the European Central Bank. He is now honorary professor at Technische Universität Berlin and a fellow of SUERF. He's an expert on central bank operations, but also payment systems, monetary policy implementation, so CBDC, market infrastructure are his bread and butter. And Stefan Ingves is the former governor of the Sveriges Riksbank, senior fellow at the Swedish House of Finance. So as a very senior central banker, he will bring his perspective on payments, CBDC, and also crisis management, because he has gone through all those steps. So I will first then give you the floor, Markus, for your remarks. Please go ahead.
Thanks a lot, Natacha, and thanks, Martin, and for the whole SUERF community for inviting me. I would like to talk about sovereignty and resilience in this context of digital money. And so when you think about sovereignties, there are three types of sovereignties which come to mind. So one is monetary sovereignty, which is the ability of a central bank to influence the macroeconomic outcome, and I will talk more about that. And once you lose the transactions, you shift to a foreign account, so you're digitized, you have digital dollarization, for example, organization outside of the euro area, then you lose your monetary sovereignty. That's one form of sovereignty you might have to consider if you introduce digital money. The second form of sovereignty is digital sovereignty. That's the ability to operate or audit or even necessarily switch off the rails on which everything is moved, the value is moved. So you might even become dependent or addicted to a digital back rail from some other country, such like a choke point you might be facing. So in digital point of time, so if you lose the back rail, and if it's a foreign back rail, I think you might lose your digital sovereignty. And then there's the financial sovereignty. That's the ability for a domestic household or the firm to access credit on domestically governed terms. And if most of the credit is allocated to foreign entities, you're in foreign big tech or other platforms, you might also be limited in a sovereignty in a sense. And for the digital money issues, sovereignty plays an important role. Now, if I look a little bit more deeply into monetary sovereignty and its components, and as I mentioned, monetary policy, if you would like to do with monetary policy, you want to manage the business cycle. So if the economy cools off, you won't like to stimulate it. If it's overheating, you would like to slow it down. And in order for the central bank to really be effective to do this, it has to control the unit of account role of money. That's one key, I think, the most important part of monetary sovereignty, and you don't want to lose it. Once you dollarize, you might lose this monetary sovereignty. A second one is, of course, you have also some seigniorage. You get some rents from money creation. To a large extent, it goes to the private sector, but to some extent, it also goes to the official sector. You're also part of monetary sovereignty. And then I also would like to have the power to exclude some entities from monetary system. That's also part of your monetary sovereignty through sanctions, or you can just exclude certain players. And finally, you also have the power to bail out and provide a lender of last resort facilities to certain players, and it's in your sovereignty to decide whom to provide a lender of last resort facility and whom not. And you might also lose the sovereignty on that. So this monetary sovereignty, as I mentioned. There's of course the digital sovereignty as well, and then there's the financial sovereignty and on top of it. And each of the sovereignty concepts is related to resilience and robustness. How resilient is your payment system? How resilient is your digital money system, and how robust it is? And I would like to contrast resilience with robustness. So by resilience, I mean you have an underlying system which innovates. And when you face a shock, the amplification is dampened because it's resilient, and there's a faster recovery. And it's not a bounce back, it's actually a bounce forward because the underlying system innovates and is adjusting to that. And that's when you focus on the resilience approach in order to maintain your unit of account or your digital money system and so forth. You want to be resilient. You might face some setbacks, but you can bounce back. But the underlying system is modifying itself and innovates in order that you can bounce back. If you follow a different approach, which is the robustness approach, you have a philosophy that it has to hold, it has to work most of the time without giving in at all. So resist any change, you maintain the current structure. And it's not that you respond to it and adjust and innovate the system such that you bounce back. You try to avoid, of course, that any setback from the beginning. So it's a much more demanding concept approach, which you probably can solve as well. And but it's way, way more demanding than a resilience approach. And it's in a world where there's radical changes all the time, it might be not a realistic approach. Earlier, I've drawn the analogy between the reed, which is more resilient, bouncing back and forth, and, you know, but always coming back, essentially, rather than the reed, the oak. The oak is just very rigid and is standing there, is not moving around at all. Now, if you have the resilience or the robustness approach, typically you have some underinvestment. So if it's done by private entities will not put enough resources into the resilience itself to make sure that, you know, the system, even though it faces some setbacks, some cyber attack or whatever it is, that it can actually come back. And that's a call for some public private partnership, in a sense that the public side has to ensure that there's enough resilience in the system. So a private platform, if there's an outage, causes some cascades to other platforms and users and to the whole macroeconomy, the private platform is not internalizing all these externalities. And that's essentially the problem we face if it's poorly privately organized, and also for daily risk circumstances. And this is specifically also for digital private money, where the cybersecurity, you know, might not be fully guaranteed the same way in order to internalize all the spillover effects and externalities. The offline capability fallbacks might not be there the same amount. And you might not ensure the interoperability is guaranteed in such a way. And interoperability itself is a very specific thing, because if it's very interoperable, it might be competitive, efficient to have it very interoperable, but also spillover effects are much more dramatic. And that's also, you know, if you allow for interoperability, you have more spillovers, and there might be hence not enough investments in the resilience of the system. And in international contexts, it also applies to cross-border settlement redundancies. Now, the architectural principles could be a tiered resilience structure where you have different layers, some public layers, some private layers, and then the cash essentially has a deep fallback layer. So the way, if you think about cash essentially is fairly resilient. It's also very robust in a sense that it will actually be operating even if all the digital cyber attacks or whatever it happens is falling apart. So cash is always there. So one structure would be that you have a public back rail like India's UPI or Brazil's PIX and so forth, and which is maximally resilient and robust, because, you know, if this doesn't work as a choke point, it's also from international threat point, it becomes a choke point in a sense, and it's public good. So you organize this in a public fashion. But then the actual money, the digital money, is sitting on top of it. And this can be much more diverse, more experimental, less individually resilient, because, you know, you can fall back, the public back rail is still there, and there might be still some alternative there because the back rail is then provided. And it's similarly what we have in the banking architecture, that the deposit insurance is essentially a public provision of money, of digital money, and the lender of last resort is the public sector. The deposit essentially is a private provision, but deposit insurance and lender of last resort is coming from the public sector. So that's essentially one way to go for that. Now, once you introduce these different forms of digital money, but you have a common back rail, you also would like to ensure the uniformity of the currency. You will have potentially many issuers of different stablecoins, CBDC and other things, but you want to ensure that there's one form of money. So many issuers of money, but one form of money. So you have to think about you would like to have a programmable money, but if money is very programmable, then actually becomes different, so it destroys the uniformity of money. And so you want to take into account how programmable should it be, how and in what way it should be programmable. Should it be programmable money itself, or should the wallets be programmable, just to make sure the money itself becomes more uniform. And so I think the uniformity of money is very, very important, because when somebody buys something and some price label is there, you would like to easily compare to comparison shopping. And if the same price is quoted, it should be the same money to be able to pay with. And you would like to eliminate any exchange rate risk or denomination risk and any other things which might come out of that. Another reason why, digital money of the official sector might be introduced is to ensure the uniformity of money. So CBDC is an insurance of uniformity of money, but it could also, on top of it, be a catalyst to coordinate banks across nations, in particular in the European Union, to have a more common, homogeneous approach of things. For example, the European Payment Initiative and other things might not work so well if the private players have to coordinate and block each other, because by blocking each other, they benefit from extracting certain rents. And by having a CBDC coming in as a threat point, out of equilibrium threat point, is actually beneficial to have a common point, threat point, and in order to get the coordination going and get the whole thing off the ground. So essentially, as I mentioned, there's a public option, CBDC, some FedNow or some other things. It doesn't need to be a digital currency, but at least, the background has to be a public option. Then there's regulation coming into thing. And then there's an out of equilibrium threat point on top of it in order to force more coordination across the various private issuers. And the way I would like to compare is 3 levers. So you can move around 3 levers. So one is, how much do you link the payments to the credit? So a payments credit link. So can it be, when you have a ledger, it can be linked, the payments and the credits can be linked. So in particular, if you take a loan, it's on the same ledger. And if you get the payment later on, immediately the payment is diverted to pay off your loan. And this way, default risk can be mitigated. And this way you have much more digital forms of collateral going on in these platform arrangements. Then there's another policy lever, which is how interoperable you want to make it. The whole thing, that's interoperability regulation. You would like to have interoperability regulation between a private payment system and a government payment system, be it FedNow, CBDC, and so forth. And you also might regulate to what extent different commercial payment systems should be interoperable to each other. So that's the second, interoperability is the second lever. And then the third lever you can choose is the privacy requirements. So you can say, I can choose the privacy on the public system, CBDC, how private is the CBDC, or should it be very well connected to the credit links, then it will be less private. So if you have a so-called, what I call smart CBDC, which is interlinked with a credit registry, and it will be much less private, or you make it very much cash-like, then it becomes very private, but then you can't use it really for the credit arrangement so much. And these are the different, for policymakers, 3 different levers they can play with. And some recent work, I derived essentially a payment credit privacy trilemma, which is Jonathan Payne, where we show essentially you can have only 2 out of the 3 desired features. If you really want the perfect credit market, you essentially end the perfect payment system and perfect privacy in the form of cash-like privacy, okay? Privacy in the same as cash has. So zero knowledge proof type privacy. You cannot have all 3 of them together. You can only pick 2 out of the 3. And I don't have the time to really go through it, but let me just say the following. If you have a smart CBDC arrangement, then it will be the case that, this public sector will create some competition, will make the perfect credit. So first best credit provisioning, essentially it improves, you need less collateral, improves credit. And you can also have, because the public sector, it also provides some payments, it also improves the payment system. Now, but if you think your CBDC should be much more privacy focused, because you would like this perfect privacy, like in cash and perfect payments, then of course you give up the perfect credit arrangement. So there are a lot of more nuances, and you can find many of these different payment systems in this trilemma figured out. And also the competition between 2 commercial payment systems, how that will play out. It could be one commercial platform focusing very much on privacy, the other one not. And this way, the privacy platform might undermine the credit provisioning. So there are a lot of interesting interactions across this trilemma. So let me conclude with this slide. I've started out with three sovereignties: monetary, digital, and financial. You can see in the trilemma that the financial, the credit comes into play as well. You can have a resilience approach or a robustness approach. In both cases, the private sector will underinvest in resilience and robustness, so you need ideally a public-private partnership in this, the bank rail, to make sure that really the essential things you have to fall back on is always provided by the public sector. And one option is a tiered resilience structure, which also ensures some uniform currency. And I concluded then with this payment credit privacy trilemma. There's a typo here on the slides. I apologize. And thanks a lot for your attention. I'm looking forward to the discussion.
Thank you very much, Markus. This payment trilemma will make us talk later, I think. Let me give the floor to Darrell, who is here. Yes.
Thank you, Natacha, and thanks also to Ernest and Martin for organizing this. It's a pleasure to be with you all. I want to talk about on-chain finance and how to provide a safe form of money for on-chain finance. Dragana, could I have the next slide, please? Yeah, so let me motivate this with the famous example of the failure of Herstatt Bank in 1974, when Herstatt conducted some foreign exchange transactions with a number of international banks and failed in the middle of the day. Those international banks and their customers lost hundreds of millions of dollars. So I'm going to, by the way, since then, there's obviously been great improvements in risk management for settlement of foreign exchange. We have, for example, CLS Bank, which is a method for controlling the risk that one bank will fail to meet its obligations to pay the other. But now we have the advantages of programmable settlement, and I want to explain roughly how that works. So in this example, the US bank will pay the EU bank $500 million in exchange for 400 million euros. I checked this morning, that's actually around 467 million euros today. Rather than using a lot of complicated and expensive infrastructure, one could have the US bank simply cryptographically sign its $500 million saying that they belong to the EU bank if and only if the EU bank similarly cryptographically signs its 400 million euros saying they belong to the US bank if the US bank has done the same. So with this, you know, the miracle of cryptography will allow each bank to collect the other's money without any settlement risk. And this has already been tested in Project Jura, which is an agreement between, or is an example of testing between the Swiss National Bank and the Banque de France. And for those of you that are insiders, Jura is the mountain range that separates Switzerland and France. And Project Cedar, the New York Fed, and the Monetary Authority of Singapore similarly tested the ability to do cryptographic settlement of large foreign exchange transactions. What I want to emphasize in the following few minutes is that this is an example of wholesale finance. This is not the typical remit of a CBDC or a retail payment system. This describes a setting in which very large financial transactions for government securities trades or foreign exchange trades or perhaps equity market block trades can be conducted. Could I have the next slide, please? Thank you, Dragana. So the minimal elements to do this are basically a state machine on which there's a programmable ledger that records each bank's position. The state XT at moment T is a record of everyone's positions and all of the agreements that exist on the programmable ledger at that point in time. So to conduct the trade that I just described, the US bank would send a message to the programmable ledger saying, pay the EU bank $500 million contingent on the ledger receiving a message from the EU bank that's analogous. Once the EU bank sends its message, instructing the ledger to transfer 400 million euros, provided the state reflects a message likewise from the US bank, Then the ledger will swap the dollars for the euros, and both banks will now have access to the currency that they had purchased. Now, for this, you don't need a blockchain necessarily. You don't even need a distributed ledger necessarily. It could be a centralized ledger, but it needs to be programmable, and if it's centralized, it should be conducted by a trusted party like a central bank. So this could be a central bank ledger. But in practice, applications so far have relied on distributed ledgers and typically some kind of a blockchain type of technology. But they need not. I want to emphasize that. Next slide, please. Here's an example of a recent transaction that was conducted on Canton, which is a programmable ledger, not blockchain, and it's highly controlled in terms of permission and privacy. In this case, this was actually done in August 25. This is not a hypothetical, it's an actual trade. The dealer is selling treasury securities, which exist in a tokenized form thanks to the deposit trust company, which is tokenizing, now authorized to tokenize treasuries and equities. The seller will assign the tokenized treasuries on the Canton programmable ledger to the buyer. The buyer will likewise assign a cash settlement instrument, in this case, the stablecoin USDC, in payment for the treasuries. And again, this is cryptographic assignment. There's no settlement risk because neither buyer nor seller has access to the other asset unless it has assigned its own asset to the other. Could I have the next slide, please? So all of these kinds of on-chain finance transactions rely, because of their scale and because of the systemic risk of this type of infrastructure, rely on a very safe and effective liquid form of money. And I'm going to list, this is my last slide, 4 options that have come forward for conducting these types of transactions. One is for the central bank to tokenize its own reserves or central bank deposits. And in that way, obviously, the money is safe and liquid because it's the unit of account and it's transferable instantly on a central bank ledger. The Swiss National Bank is the only one with a live application that has this feature. The central banks play a very important role in this setting. The principles for financial market infrastructure under CPMI IOSCO actually stipulate that it's the natural role of the central bank to provide the form of money or to ensure that there is a safe form of money for these types of transactions. And this is critical financial market infrastructure. The central bank should take responsibility to either do this or see that it's done. A second option, which is also central bank based, is to synchronize the programmable ledger with RTGS cash settlement in conventional central bank reserves. This is not a CBDC. Neither of these are CBDCs. This is, which I would tend to use that term, especially in the United States, only for retail applications. This has been tested at the ECB and Project Pontes at the Bank of England and at the Swiss National Bank, a second option that SNB has provided. Now, the PFMI of CPMI IOSCO say that it's okay to use private money if it's essentially as safe and liquid as central bank money. An example of that would be a narrow bank that issues tokenized deposits. The word narrow bank means that these tokenized deposits would be backed 100% by central bank deposits. An example of that is Finality, and it has up and running this form of tokenized deposits backed by Bank of England sterling settlement account. The last option would be to provide a stablecoin that's backed by assets whose market value is essentially equal to 1 unit of account. For example, in a note with Don Wilson, we proposed the issuance of government notes that are auctioned with a floating rate that are auctioned daily for 1 unit of account. That has the safety and not quite the liquidity, but almost the liquidity of central bank deposits. A second option might be a money market mutual fund that's put on chain and that invests exclusively in overnight treasury repos, which are worth one every day. So it should be relatively safe. I think option 4 is not as good as any of the other 3 options because it's one step removed from central bank money. Option 3 is about a half step removed from central bank money, and options 1 and 2 are central bank money. I want to emphasize that we are experiencing significant growth of on-chain finance if this trend continues because of the advantages of programmable settlement that I have described. We are painting ourselves into a corner unless we obtain the safety and efficiency of central bank money, or effectively central bank money, for the cash settlement leg. We are looking at a situation in which in some cases, a stablecoin, which is perfectly fine for retail transactions, could depeg to the extent of, let's say, 0.999 in value rather than 1. And while for retail applications, 0.999 might seem perfectly safe, it is far from perfectly safe for a billion-dollar treasury repo. If market participants had the view that they were going to receive 0.999 in exchange for their treasury repos, the repurchase agreement market could break down. And if on-chain finance becomes the main approach in the treasury repo market, that would be simply unsatisfactory. It would be extreme systemic risk. So leave it up to you central bankers out there to resolve this issue. It is your responsibility. Thank you.
Thank you, Darrell. And this resonates well with the money market data that the ECB is releasing regularly, and that shows that the repo market is very, very much in potentially of a systemic importance, if not to say issue. But let me give the floor to Ulrich now. We have already quite a few questions on the chat, but I keep them for the discussion afterwards. Ulrich.
Yeah, thank you. And I would share my slides myself. 1 second. I hope this works. Yeah, you can. I hope you can see my slides. And I would zoom on one topic, which is really the remuneration of money of the future. And yeah, let me start with some definitions. Sorry. Yeah, money. Okay, money is used a bit interchangeably in 2 meanings. One is the means of payment, really money to fulfill the means of payment function, what is readily usable anytime without liquidity or market risk, which can be directly, used for paying, being matched with executable prices, while the other thing is invested money. And invested money is money which is not readily available. It's a cash flow in the future period, or it is subject to market risk. And of course, for the discussion on remunerating money or not, this distinction is very important. And yeah, moving to remuneration, this ambiguity also seems to exist. And interestingly, MICAR is, spotted this and is very explicit in suppressing remuneration of stablecoins. And that includes very clearly in their case also any remuneration of sort of fixed deposits, fixed time deposits of stablecoins. So anything would be excluded there. So in this sense, MICA imposes really a double additional constraint on stablecoins relative to commercial bank deposits, which can of course be remunerated in the form of sight deposits, but even in the form of readily available deposits for payments. Some, very brief history of thought, a bit all over the place for a second. I mean, the topic of suppressing or preventing interest on money is a very old one, and it does even, go further back than maybe Christians not being allowed to charge interest to other Christians. And so it's a whole, I would say, discussion of millennia. And in the 16th century, the Pope ruled that 5% was an acceptable rate in principle. Of course, economists would say that constraining price formation without proven market failure is not a good idea and normally makes everyone worse off and is therefore normally inconsistent with the initial intentions. But moving forward, Gesell and also Friedman had this vision of negative returns of money, or let's say of producing a deflationary context to avoiding that holding money has opportunity costs in principle, which goes a bit in the direction of remunerating means of payments, although taking a special approach to it. And then maybe, people who have taken up the topic then again later on are Black in 1970 and Farmer in 1980s, who both discuss a world where banks are free to remunerate sight deposits, and they're excited about the question whether there is an equilibrium, a monetary sort of equilibrium and determinacy of prices if you remove this regulation, which at that time was Regulation Q applying in the US. And Black comes to conclusions which are now difficult to really understand, but in line with macroeconomic authors of preceding years that there would be an issue, while Farmer, says the opposite, which is intuitive to us today, saying that this is unspectacular to allow banks to remunerate sight deposits. It would just be a matter of transaction costs, like asset liquidation costs, which would determine the remuneration of sight deposits. Regulation Q, to look at this episode where also sight deposits could not be remunerated, and the justifications of this act were, somehow, similar to what you hear maybe today when discussion of new forms of money, remuneration of new forms of money is being discussed. So, for example, country banks would lend too much to larger banks in financial centers in the form of deposits to obtain remuneration, and those big banks would use them for speculative purposes instead of providing credit to the real economy. And also there was a feeling that one could increase bank profits by prohibiting interest, by limiting competition. A strange argument, but in those years there was this feeling that banks should have higher profits. And then in the late 70s, when interest rates went really high, Regulation Q caused, of course, problems, outflows of deposits, and then Regulation Q was phased out in 82. Another, perspective on this was interest on reserves. In 2006, in the US, the Financial Service Regulatory Relief Act authorized the Fed to pay interest, was supposed to be effective in 2011, only then it was advanced to 2008, and interest on reserves was for the first time then allowed in almost 100 years of Fed history in 2008, and as you know, is still being used. Eurosystem, similar, let's say, development, but different timeline. As of 1999, the Eurosystem had a deposit facility, but banks just have to transfer at the end of the day money there, and then they get remunerated and can get it back next day. Interestingly, the Bank of Finland had already in 1999 an automatic remuneration of any excess reserves. So in this sense, just remunerating the sight deposits of banks. And I think everybody somehow admitted that this is more efficient. The rest of the Eurosystem was reluctant, and it took 27 years for the Eurosystem to acknowledge this really, and to accept the change of the systems that would allow for automatic remuneration of any reserve holdings in line with the deposit facility rate. CBDC, next topic where this was discussed, and now we come really to the future of money, which should be the topic today. So one could say from 15 to 20, remuneration of CBDC was discussed extensively, and there were two schools of economists that promoted remuneration, and I call them here the activists and the pacifists. The activists, represented by Darrell, Kumhoff and others, monetary macroeconomists who saw in the remuneration of CBDC a new, useful, independent, additional monetary policy tool, which would allow improving macroeconomic outcomes. There are various papers, which play with interest rate rules on CBDC and show that this is great. But then there were also the pacifists, and I put myself into this camp, who would say, no, I mean, one should remunerate CBDC, but not for the reasons that those activists claim, but for correcting the anomaly that banknotes are unremunerated whatever interest rate level prevails in the economy, which creates non-intended flows of funds, not only in the negative interest rate context, but of course it makes a difference if nominal rates are 50% or 5% for this effect. And under the pacifist interest on CBDC would just be moved normally in parallel with other official rates, would reflect liquidity premia, and would be such that it would not invite large-scale investments into CBDC. But anyway, neither of those schools of economists had any impact, because an unholy alliance against remuneration easily won. And this unholy alliance consisted of financial repression conspiracies that feared that negative remuneration and the idea or the assumption that CBDC is part of a plot to discontinue banknotes would open the door for unlimited negative interest rate policies. On the other side were the banks fearing positive remuneration to create competitive pressures on remunerating sight deposits. Non-economists, lawyers, etc. anyway do not see the point. And central banks were easily ready to compromise to keep hope to issue CBDC despite all this opposition, and anticipating the likely instrumentalization of remuneration by the opponents. Stablecoins, I already mentioned, MiCA is super explicit, prohibits also any form of rewards and remuneration of term deposits in stablecoins. The Genius Act is only prohibiting, let's say, remuneration, direct remuneration. And according to the US Banking Association in a letter, this restriction is easily bypassed, and it is bypassed because, for example, Barbon et al. Find that 86 billion out of total 290 billion stablecoins are effectively remunerated. And this goes via the exchanges, the wallet providers who get money from the stablecoin issuers to then, present rewards, not calling them interest. And currently the fight around this is ongoing in the US, and a compromise seems to emerge in the Clarity Act. Sorry. Let me say why I believe money should not be remuneration constrained. This is because, it's a self-defeating anachronism I just claim here. The world is nearly fully digitalized or electronic, 24/7 immediacy, straight through processing, low transaction cost, already discussed in Black and Pharma. The substitutability between forms of money is extremely high today. And already Keynes, noted that money only differs, or means of payment and within the spectrums of money differs only in degree from other articles deriving its importance from having a greater liquidity premium than any other article. But this liquidity premium for readily available money cannot, it cannot make sense to make it fluctuate with short-term market rates, so that sometimes it's -1%, sometimes 2, sometimes 5, sometimes 40%. That has no economic rationale, creates non-neutrality. Complexity is a recipe for financial instability. As economists, we cannot defend this. I mean, some would just say this is to protect banks. But if you want to protect banks, you have to argue that banks have a positive externality. And this is not only, synergies between deposit and lending services. To have synergies in production does not mean that you have a positive externality. And I'm not aware of anyone who has convincingly argued that there is a positive externality of banking. And even if there would be such a positive externality, it should be addressed by a PIGU tax on competitors or subsidies of banks, which are independently of the interest rate cycle. So just constraining remuneration of competing forms of money to zero doesn't make sense. And if you take the example of stablecoins, and what illustrates it, if stablecoins would really be unremunerated, everybody should have a preference to hold Swiss franc stablecoins, because Swiss franc has typically a low interest rate level, but a tendency to appreciate over time. Of course, freedom to remunerate stablecoins doesn't mean that they would follow closely market rates. There is a liquidity premium on readily available money that should be not zero. And on CBDC, I think the consequence of not accepting remuneration, including sometimes negative remuneration of high holdings, was to accept quantity constraints on CBDCs. And this, I would say, is quite a serious defeat. So central bank money is quantity constrained in a world where nothing else is subject to similar constraints. So this is, one could say, with Nietzsche, a reversal of values, as normally we would expect the public sector setting constraints on the private sector, not the other way around. And normally we would expect commercial bank money to be junior to central bank money, and not the other way around, as it seems to emerge potentially with digital euro. If digital euro is only a payment instrument layer on top of commercial bank money. Yeah, let me stop here.
Very clear views, Ulrich. We'll have discussions on this, I'm sure, but that's well documented. Thank you very much. And I give the floor to our last speaker, Stefan.
Well, thank you. And could I get the slides? Next slide, please. Yeah, I'm going to say a few words, and being the last speaker, of course, it's hard to come with completely new things given that so many wise things have already been said. But let me start and give it a try. First of all, money is a convention. I think it's important to keep that in mind, because money is essentially about what we have in our heads. And then when you talk about money or different forms of money, you'd like to engineer a convention such that it's accepted by as many people as possible, because otherwise, if that's not the case, then you end up with many monies using the plural, and that kind of a system does not work well. When you think about what's going on presently, actually, most things have been tried in the past. Some of them worked, some of them did not work at all. And that's because technologies change over time, but the basics don't change over time. And sometimes that is forgotten, particularly if you approach the whole issue of money from the technological side, because then you usually have not spent a lot of time studying the history of money. In the past, everything was on paper. In the future, nothing will be on paper. It's all digital. And it's important to keep that in mind, because when we talk about money, or money is using the plural, we still sort of think about things that is in one way or the other physical, but that's not the case when we move into the future. In addition to all the other things that already have been said about money, let me add that for people to use your money you need what I call transactional efficiency, which is very often not mentioned at all. Because if it's very, very hard to transact using your own money, you're going to use somebody else's money. And that means that it's worthwhile spending a bit of time on thinking about payment systems and the like, because otherwise everything is likely to move somewhere else. And in the old days, basically what everybody used was what I have chosen to call centralized ledger technology. And you can go back actually to Banco di Napoli starting in 1463, and everything is there on paper, 1 meter after the other in the museum, and you can read it and find it all. And basically nothing much has changed in terms of how you've been thinking about these things. And that holds when it comes to what I call mainframe legacy banks, because the whole old structure is basically based on centralized ledger technology in one form or the other. And these banks, together with the central bank, is what I call the old fiat money club. And that matters. Next slide, please. And here we have a legacy challenge. And the challenge is distributed ledger, DLT, or tokens in one form or the other. And setting the technicalities aside, of course, you have all sorts of kind of hybrid versions of these things as well. This was not technically feasible in the past, particularly not during the paper days, because we would have run out of trees to put DLT on paper. And banks and central banks are conservative, so it takes a while for them to get their heads around in inventions. And also what I think is important is that if you control the system, then you engineer slow oligopolistic behavior in one way or the other. And I think that is certainly the case when it comes to legacy banks. And what matters here is both what the back-end systems, and Markus has already sort of pointed at this, the target system, target to securities, tips cross-border, and other back-end systems that you don't see. All of them are sort of CLT in one form or the other. And then in addition to that, you have the combination of backend with front end, which is Visa, MasterCard, PayPal, Apple Pay, and a whole bunch of other systems that have emerged, PIX, and in Brazil and India and so forth. When you look at this, and I'm not a technical guy, it's not absolutely clear that centralized ledger technology is inferior to distributed ledger, because you can run these things also 24/7 if you want to do it, but it really matters what kind of system you prefer to put in place for the economy as a whole. Next slide, please. And when it comes to DLT, staying out of lengthy discussions of this, we have permission versus permissionless. We have the whole issue of legal frameworks, and this matters a lot, because really what defines a financial product is the technology you use in combination with whatever legal framework or lack of a legal framework you happen to have in place. Others have referred to Genius and MiCAR already. But it is very, very important to keep in mind that it's not what sits on the hard drive of a computer that defines what you owe or own. Ultimately, you need some kind of a legal framework to back it up. Others have already pointed out the whole issue of smart contracts and all the nice things that we can envision when it comes to what smart contracts can do into the future. Serious issue, particularly when it is permissionless, is the whole issue of anti-money laundering, combating the financing of terrorism, and to what extent we actually can or cannot control these systems. And then also, of course, what type of a legal entity we're really talking about. Is this just a way of recreating banks, or do these new features have some unique ways of doing things in such a way that it's something that is adding something to traditional banking. Time will tell when it comes to that part of it. Now, next slide, please. And this, of course, creates a whole new environment where we have to decide, or particularly central banks and regulators and others and lawmakers have to decide where to go. Are we talking CLT or DLT, or are we talking about hybrid solutions? I don't have the answer to this as of today. We have the whole issue of central bank digital currencies, whether they're wholesale or retail. These questions actually need to be answered in one form or the other. One example, and this comes from China, where they have a de facto CBDC, but operated by the private sector, because they require that there is a 100% reserve ratio. So it's sort of a two-tier system, but de facto one, more or less, it's like a CBDC. Then we have the whole issue of stable coins, and that's a deep topic in itself. And let me give you a few examples here that will matter, and probably matter quite a lot when things are taken forward. In the UK, if I'm informed correctly, they're thinking about a stable coin, but with a requirement of a 40% central bank reserve requirement, which, by the way, is very similar to the way private bank issuance of banknotes were handled in Sweden in the 1800s. So there's nothing new under the sun when it comes to money. We have Genius and Mikar with safe assets, and we can argue about safe assets, but with no interest payment. And then, as an example, I came up. It must be possible to put money market funds on a blockchain. And I find it very hard to see why you would hold Genius or Mika stable coins if you have a choice between that and holding a money market fund asset, which actually pays interest. And then, of course, we have the whole issue of tokenized deposits. So my view is that the old legacy banks are about to fight back in one form or the other, despite them being a bit on the slow side. And then my final slide, please. So central banks certainly have some choices to make when it comes to this, but these choices are not pure economic issues. There are also political issues, because ultimately, given the fact that we do have central banks, they didn't come into existence out of thin air. They actually came into existence because there also was a political debate about to what extent we need a central bank or not, and what it is supposed to be and what it is supposed to do. Another issue that will come to the fore is how much oligopoly power do we want private banks to have? And how do we deal with that issue? That there is massive pushback on the side of the banks, that is not surprising at all when we talk about CBDCs, because at least in the case of Sweden, the debate was exactly the same in the late 1880s and 1890s, when the discussion was about private banks issuing their own banknotes. So my own view, sort of old-fashioned, is that money is part of how you define a nation. Central banks need to speed up these things, they need to actually invest and do things, not just write memos. But central bankers are better at writing memos than actually getting things done, because that's what central banks are trained to do. I firmly believe that CBDCs will not threaten the banks. And I also think that without a CBDC in one form or the other, we have privatized money. And if that happens, wait until you have a problem in the system as a whole, and wait until people find out, and they will ask the politicians who allowed this to happen. So I don't think that is a good scenario. So essentially what I'm talking about here is, in a very old-fashioned way, in a digital world, moving everything into a digital world, but roughly something which is fairly similar to what we have had for 100 years or more already when everything was on paper. Thank you.
Thank you very much, Stefan. I think central banks are speeding up a bit, we can say, maybe, but the banking sector lobby is very strong. Just as an anecdote, sometimes I reply to Ulrich's posts on LinkedIn, and I have been contacted by the French Banking Federation, and they are organizing a session to educate the former central bankers to what the system should look like. So that's a very active link. There are quite a few comments on the chat, but I'm trying to summarize it and to frame it into a handful of questions so that we can go once again through all of you for the topics I will mention. And apologies for those remarks that have been too long and technical to be here in the list. But one question was the opinion on the 100% sovereign money system, like how it was in old days. What do you think about it? A second one, which is more forward-looking, is US versus EU. That was Kailun Lo and Pedro asking this. Who will win? What will prevail? What will be the steady state in half a decade or a decade? Will it be more towards the ECB way to look at things that looks at privacy and stability, or the US that looks at payments and innovation more, and the associated problems to each of the approaches? There was one question, I think it was to Darrell, on the specifics of a case for FX exchange between banks. I don't know if you read the comment, but how does the central bank ledger works in that case more specifically? And there was another question to everyone, I think, which is interesting, is by Gabriela. How can the EU use strategically its financial convergence through, CBDC and through its general approach to money in the future? How can these be harnessed to the capital markets union and further integration, in the context of giving incentives to non-Euro members to become closer to the Euro pool? And finally, perhaps Maria Elena's question, what is society giving up with not having a remuneration retail CBDC? That's a question to Ulrich. Sorry, I hope that was not too long of a summary of the questions. Maybe we'll go in the same order, if you don't mind, to answer the ones you see more fit, but it would be good to have your view, to all of you. What is the future, steady state? How will it look like to your view? Thank you.
Thanks a lot. Very interesting talks and a lot of food for thought. So let me ask a few questions to the panel members and then also to the audience, address some of their questions. For Darrell, I have a question about tokenization of the reserves. Essentially, a lot of the proposals you propose is you tokenize a lot of the reserves. Does it square well with downsizing the Fed's balance sheet, like Kevin Wirsch wants to do? I know that the option 4 was a way out, but you were not very favorable for the option 4. So do we have to live with a big balance sheet size in the future? And is this a problem? For Ulrich, I would like to ask you, there's this theory that you want to give banks a stick and a carrot. So you give them a lot of bank regulation, and in order to keep them in the regulated perimeter, you have to give them some carrots as well. And one carrot could be, as Stefan pointed out, that you don't enforce competition so much. So in particular, you prevent competition from stablecoins and from CBDC not enumerating. I'm not saying I'm in favor of that, but I'm just saying that's one theory you didn't mention, and this I was just wondering. And for Stefan, it's related to that. You said you want to move everything from what we have done, and for hundreds of years we move it to the digital world. But cash we didn't enumerate it. You didn't answer whether you would like to put an interest payment on cash or on digital forms of cash on CBDC or not. I was just curious what your thinking was. So concerning the questions from the audience, I'll try make a quick attempt. So narrow banks, I think, is my view. I can live with narrow banks. I think it's fine. Of course, if you force banks only to narrow banking, there might be a limit less credit provision to the real economy. And we have to actually study some, how the growth implications are. And of course, the only paper I know is by Sebastian Merkel, who really put this in a macroeconomic framework and then said, okay, what are the implications of narrow banking on the real growth rate for the macroeconomy? And we have to take this into account. And this might be quite costly to some extent. It might give you some benefit on stability side, but it also lowers the growth rate of the macroeconomy. And this is in the long run quite some welfare losses. About the US versus European Union or Euro area, it's true that you might think that the US is more innovative in all this and promotes stable coins and the new things coming up, while the European Union is actually regulating everything and might more privacy focused, more stability focused. But if you look at payments very specifically, there are a lot of vested interest in the United States, which also prevent innovation. So there's not so much innovation going on. Certain payment aspects, I would say, are more modern in the European Union than in the United States. And it's because some rents were just eroded. So and there's a lot of rent protection in the United States as well. And it's not only innovation. So it's not clear that a clear framework would not help innovation, in particular if you have a back rail and a front rail, as Stefan mentioned as well. And can you use strategically the CBDC to harness on essentially capital markets union? I think definitely yes. And it should be also used this way. It's as what I mentioned, this out of equilibrium threat. We do that, and and for this, of course, you have to pay interest on CBDC because otherwise it will not be picked up. I don't think it will go anywhere without any interest payments, but it can be used to force the market unions to harmonize many other aspects as well. I think that would be a forceful force here, and I think that I see this the same way as the question I asked. Let me leave it at that. Thanks a lot for all the questions and all for other contributions.
Thank you, Markus. Darrell.
Thank you, Natacha. The question in the chat for me is related to the benefits of on-chain finance. What are they? And I already mentioned the notion of counterparty risk and in settlement. But actually, the primary motivation today and for the next few years is quite mundane. It's 24/7. So we could do all of that on a 24/7 centralized ledger. And I think Stefan Ingves' remarks were consistent with that. But that's what everyone wants. And currently, central banks have not provided, in most cases, 24/7 payment systems that could mesh with 24/7 ledgers of assets. So that's a big advantage. It's the big driver today. Nobody wants to stack up money in advance of a 3-day weekend or a 2-day weekend. They want to be able to do 24/7. Another advantage is transparency, controlled transparency, so that you can actually see what you've got and you can see the transactions you've made. And that doesn't mean blockchain transparency where the whole world can see what you have. It means transparency that's controlled to the parties that need to know. And that could include regulators. So AML, CFT, and financial stability monitoring can be conducted much more efficiently on on-chain finance. The last one is also related to transparency. It's called trade reconciliation. So when I send Markus my securities, I don't need to say, did you get them, Markus? And did you send me the euros that you owe me? It's all recorded live on the blockchain, including what we agreed to do by when. Markus asked a very good question, which is, what does this mean for the size of the central bank's balance sheet? If we start to fragment the way that reserves are supplied by the central bank, might that increase the required size of the central bank's balance sheet? And the answer is, depends on design, but yes, if you don't do a clever design, it would. And the key elements for avoiding expansion of the balance sheet is that every ledger that depends on access to the tokenized reserves needs to have 24/7 fungibility with the central bank's ledger in order not to expand the central bank's balance sheet. Let me unpack that and then I'll finish. If market participants want to store central bank money or narrow bank money backed by central bank deposits on several ledgers, and they don't have instant 24/7 access, those ledgers don't have instant 24/7 access to each other, then market participants will stack up their various monies on various different ledgers, and you won't get the benefits of netting and simultaneity that you would need to keep the central bank's balance sheet down to size. And size does seem to be a concern for some central banks. So yes, the design is very important. Fewer ledgers and 24/7 fungibility among them will take care of this problem.
Thank you. Ulrich?
Yeah, thank you. And if I can also, just cross comment, and on what Darrell, Darrell, you were very excited about this possibility of kind of atomic settlement and programmable ledgers and so on. But I would also, be a bit in Stefan's camp, a bit skeptical on, what that has to do with blockchain and DLT. And blockchain and DLT comes from DeFi, and what DeFi promised is that code beats law. That you don't need law, you need code. And but then in practice, DeFi constantly betrays its own principle. If you look at the DeFi world as it has evolved, you have permissioned ledgers, and you can, those permissioned ledgers anyway, they have normally a governance, and the value added of the DeFi components is very limited. What you have is multi-asset availability, which is a new kind of approach. You overcome the fragmentation that Darrell, you have mentioned then, which indeed should be overcome. But, those BIS experiments, Innovation Hub experiments you mentioned, I was always, not so impressed by them, because, who would be surprised by the fact that you can, whatever, in DLT or not in DLT, do an experiment where you program that two assets are exchanged on a ledger in an atomic manner. Technically, this is not surprising that you can do that. I was never so, by those experiments, a lot of effort for proving something that could not, end up differently than that you can show that this works somehow. What matters in practice is at the end, legal concepts, legal certainty, settlement finality, is what you have tokenized on some ledgers. Do you have an effective claim at the end on the underlying assets? So all those things which then are, the opposite of what Duffie was promising, that code is, can emancipate you from law, which is, impossible for anything which is wholesale anyway. So I think there are lots of things which are a bit oversold. And also, if you look at T2S, nobody has ever been so kind to call T2S a programmable platform, but everything, like atomic settlement and let's say programs that look for, settling things if all the conditions are fulfilled in an atomic manner, all that is in T2S. So I would say again, it's not DeFi which allows any of that. And then, just to come back to what Markus you said, I agree. This idea that protecting banks from competition is a carrot they get in exchange for being regulated. But of course, that's not the first best of the world. You should regulate everything in a way to, address market failures. And this, even, if you would say this, you should give this carrot to the banks, you should design then a PIGU tax on competitors, which is not, cannot be 50% if interest rate level is 50%. And fluctuate randomly, with the actual need to protect banks. So yeah, as economists, we should say no to this and just make sure that regulation is consistent and as heavy on anyone as it is deserved and justifiable. And yeah, okay. And then on the questions of the public, yeah, sovereign money, I mean, is some people indeed in 2016 in the early days, and then later with some initiatives still were claiming that CBDC is a great occasion, you know, a new technology, the fact that you can now do everything electronically is just a great occasion to overcome the drawbacks of private money, the financial instability. You could reach all the network effects of money in one go by the central bank. And yeah, I mean, in fact, I would say this reasoning is still, I wouldn't see, you know, so obvious arguments against it necessarily. But central banks have not been courageous to consider it. I mean, more closely. So it's not something really debated. The central bank, the ECB, is saying, no, we don't want to change. We want, you know, CBDC is just a matter of being conservative and preserving a role of central bank money, but not to extend it. Yeah, with unremunerated CBDC, I think the problem is we ended up with narrowly constrained, limited CBDC, I think overly constrained. And yeah, it's just not reaping the possibilities you have with an electronic form of money to overcome the non-neutrality of non-remuneration. And so the battle of the best design of CBDC continues. And with limitations, you can still design it better or not so good. And I hope the ECB is doing its best for that.
Very good. Thank you, Ulrich. And Stefan?
Yeah,
I've just been allowed by the Secretary General to to have 5-10 more additional minutes if needed. So don't feel constrained too much by the time. Go ahead. Sorry.
Thank you. Many good questions and reflections. First, on the issue of remuneration. In the case of the Riksbank, as far as I recall, the Riksbank has paid interest on deposits and certificates of deposits for 30 years at least, or something like that. And no bank has argued that messes up the banking sector, because that's how you actually do monetary policy, because it's part of the monetary policy framework. That's how you propagate monetary policy through the through the system, and that doesn't really create any problems. As an aside, the Riksbank has also used a zero reserve ratio for 30 years or something like that, and contrary to many other central banks, that wasn't a problem either. So that essentially leaves us with the issue of whether one should pay interest on a central bank digital currency more at the retail level. And I have no idea when that will happen, but eventually I do think that it will come in one form or the other. But if we're talking 10 years, 20 years, 30 years, I just don't know, because eventually people will find out and realize that why is it that my bank is being paid interest when the bank deposits money with the central bank, but when I hold something digital on my cell phone, I'm not paid at all. So what's the point? And so eventually I do think it will come, and it's not a technical issue. Darrell's point about running things 24/7 is highly relevant. But here an issue is also to what Markus was talking about, legacy systems and legacy issues, because it's actually very hard to get the banking community to agree to change. And they're constantly watching each other. So there needs to be somebody looking after the public interest in the middle to make these things happen, and that is usually the central bank in one way or the other. And normally the way to do it, for example, when you're just using that as an example, when you develop target 2 securities and the tip system, is basically to tell the banks that if you want to participate in monetary policy transactions, you also have to do these other things because it's good for you. And if you don't like to do that, then you can wander off and do something else somewhere else, because people always tend to forget when you're talking about banks that it's voluntary to become a bank. And if you don't like it, go and do something else, start a sausage factory. And somebody's got to look after the public interest in all of this. I'm not saying that it necessarily is easy to do, because it is always a balancing act how to do this and kind of how to do it properly. But it's obvious that there is some kind of an issue in the private sector when it comes to getting the banks to agree on certain standards, or getting the banks to agree on how to do things. And I do think that it's a failure, both on the side of the private sector, but also actually on the side of the public sector when it comes to cross-border transactions, and particularly small value cross-border transactions. And that's why you get all these, I call them alternative instruments, because it just costs too much money and it takes too long, and it's not technically a problem at all anymore. All of this is actually doable, provided that somebody is kind of pushing the banks and others in that particular direction. Or maybe in the future it's just such that if you run a bank, a commercial bank, you just get out of payments, and then you have others taking over doing payments. And if that is the case, those who are actually doing payments at a low cost and efficiently will have to have some kind of a connection to the central bank in one form or the other.
Thank you, Stefan. Very complementary to what has been said before. I cannot summarize everything. We'll just a few minutes left, and I'm warning the panelists so that they get ready, but I'll give you 1 minute to tell us how will we pay in 2030, and we'll go in the reverse order. But while you think about your 1 minute statement, just summarizing the further comments that have come through the chat. One question on the sequencing of what will happen. Will CBDC come first? The regulatory changes relative to stablecoins, how will this be sequenced in the future? Second question, how to prevent underinvestment in systemic resilience? That's from Ernest. And then at the end, there's a sort of skepticism that emerged from the chat on DLT, basically saying this is slow and the speed is an issue, and what about the hacking risks and the cyber risks that are likely to emerge to a large scale? So that's what has been said while you were all responding. So your final word, 1 minute each, on how will we pay in 2030, and if you want to say something else, obviously, please feel free. Stefan.
If the legacy banks and the central banks mismanage this, then everything will move, or a lot of it will move into stablecoin in one form or the other. And that is very dangerous if you talk about it in terms of your own currency, because that could produce a result where you de facto have two central banks in one country. And that's not a good place to be. I'll stop there.
Very clear. Thank you. Ulrich?
Yeah, I mean, your very specific question, how will we pay to 2030? We will pay with Apple Pay at the point of sale, because this is we are doing this now, and digital euro, even if will be rather successful, will just be, I mean, will start to be deployed in 2029. So 2030 it will all be Apple Pay, and we will make Apple happy. And if I can say, on DLT is slow, I think that's an important remark. DeFi is, a real luxury, because it assumes there's no central authority, and therefore you have to construct something which is really inefficient in a world with a rule of the law and central parties you can trust. And therefore, much of the things we are discussing, I think, I mean, much of what DLT or what all this is in practice is a betrayal of DeFi principles, and there's a lot of regulatory arbitrage, And I think we should regain self-confidence on central ledgers, even if there are multiple asset ledgers hosting multiple assets, being reprogrammed, being modern, whatever. But we should not, swallow too easy all the narratives. And I include here, if I may state to Stefan, that stablecoins will be the future. I mean, pseudo stablecoins, but not stablecoins which are really settled, on a DeFi network, because that's too inefficient. That is not attractive. I mean, some narrow money construct that is distributed in some way on pseudo DeFi, maybe, yes, and we can call it stablecoin.
Thank you. Darrell, your turn.
I have a hard time predicting whether Europe will move on to a digital euro-based payment system, but I can speak more confidently about the domestic U.S. economy. I don't think we're going to see a stablecoin or a digital currency in the United States, not even in 5 years or in 10 years. I would like to say we're going to see something like a PIX or UPI in the form of FedNow all-to-all, but unfortunately, the banks are probably not going to move to that, and we're going to continue doing what Ulrich predicted, which is Apple Pay and other types of credit card payments. On the wholesale side, I totally agree with Ulrich. The DeFi is not at all an essential ingredient, and it's a big disadvantage. And I predict we will be using programmable ledgers, relatively centralized, possibly some permissioned based, but relatively centralized programmable ledgers.
Yeah,
Thank
let me
you.
join, perhaps
Yes.
I can, instead of 2030, let me say 2033 or something.
That's
Let
a
me
good
make a
shift.
bold statement. I will not make any payments anymore. My AI agent will make my payments. And for this, we need some centralized payment ledger. But I think at that time, we won't make payments. It will happen automatically.
It will be a seamless world where we all share leisure time with each other. On that note, thank you very much, Markus, Darrell, Ulrich, Stefan. Thanks to Martin as well for curating this panel, and to SUERF for hosting it. Thanks to the audience for the wealth of comments that we've received. I think the topic was fantastic. Have a nice evening for some, afternoon for others, and see you next time. Goodbye.
Goodbye. Thank you.
Bye-bye. Thanks all.
Bye-bye.
Thanks, everyone.
Thank you.